While Wall Street spent the last 50 years building a trillion-dollar fortress of advanced algorithms, multi-factor models, and complex derivatives to make the market feel like an enigmatic science, the ultimate academic secret is that the most successful investing strategy is so simple it can be written on an index card. And that simplicity is Wall Street's greatest existential threat.
Every afternoon at exactly 4 o'clock, the floor of the New York Stock Exchange erupts. Brokers cheer, bell ringers smile, and television cameras broadcast a scene of absolute triumph to millions of screens around the world. But if you watch closely, a strange paradox emerges. They cheer when the market reaches historic highs, but they also cheer when the market crashes, wiping out trillions of dollars in household wealth. Why? Because on Wall Street, the house always wins. Whether you make money or lose it, the brokers, the advisors, and the fund managers receive their cut. In the famous words of Blaise Pascal, all of human unhappiness comes from one single thing: not knowing how to remain at rest in a room. Wall Street's entire business model relies on making sure you never remain at rest. For more than half a century, the financial services industry has engaged in a highly sophisticated, multi-trillion-dollar campaign. Its objective is simple: to convince you that the modern financial system is an enigmatic, highly technical science that is far too complex for the average citizen to navigate alone. They shroud the market in high-speed algorithms, multi-factor risk models, alternative risk premia, and complex derivatives. But what if the complexity is not a product of necessity, but of marketing? What if the financial industry's most closely guarded secret is that the most effective way to build wealth is so incredibly simple, low-cost, and passive that it renders the entire apparatus of Wall Street completely obsolete? This is the story of how complexity became a commodity, how noise was packaged as signal, and why the simplest path to wealth is the one thing the financial industry cannot afford to let you discover. To understand how the modern financial system functions, we must strip away the computer screens, the tickers, and the jargon, and look at a simple parable popularized by legendary investor John Bogle. Imagine a massive, wealthy family called the Gottrocks. The Gottrocks family owns 100% of all the corporations in the United States. Every year, as these businesses grow, sell products, and innovate, they generate real profits. These profits are distributed directly to the Gottrocks family in the form of dividends and reinvested earnings. Because they own the entire pie, their wealth compounds in perfect lockstep with the productivity of the nation's economy. This is the simple, unvarnished story of wealth accumulation. It is clean, it is quiet, and it is incredibly powerful. But as the decades pass, a group of sweet-talking helpers enters the scene. These helpers whisper in the ears of the Gottrocks family members, telling them that they can outsmart their relatives. Why settle for the average return of all businesses, they ask, when you can sell the underperforming stocks and buy the high-growth winners? The family members are seduced. They begin trading with one another. They hire brokers to execute their trades, financial planners to manage their portfolios, and active mutual fund managers to pick the best stocks. Now, let us look at the relentless rules of humble arithmetic. Did the businesses themselves become more productive because the family members started trading? No. Did corporate earnings increase? No. But every single time a stock was traded, a broker took a commission. Every time an active fund manager bought a new stock, transaction costs were incurred. Every year, the wealth managers charged a percentage fee of the total assets to supervise the accounts. Instead of receiving 100% of the corporate earnings, the Gottrocks family now receives only a fraction of the pie. The rest is consumed by the intermediate costs of the financial system, the helper's tax. The family's net return is simply the gross return of their businesses minus the costs they incur. Over a lifetime of investing, this seemingly minor leakage can confiscate more than half of an investor's potential wealth. The helpers have successfully turned a simple, productive system into a friction-heavy wealth extraction machine. In any other industry, if a business model was shown to actively reduce the value of the customer's product while charging a premium for the service, it would go bankrupt. To survive, Wall Street had to solve a critical marketing problem. How do you convince the Gottrocks family to keep paying the helpers when the raw math proves they would be better off on autopilot? The answer was complexity. Financial instruments at their core exist to fulfill four basic human needs: raising capital, allocating scarce resources over time, protecting against spending shocks, and mitigating risk. But once a financial product is created, it also fulfills another, more volatile human urge, the urge to speculate or bet on short-term price movements. To satisfy this urge, the financial industry began constructing a vast and dizzying array of sophisticated instruments. Today, at the Chicago Mercantile Exchange, you can purchase futures contracts based on the average daily temperature in Los Angeles. At the Chicago Board of Trade, you can buy and sell the legal right to emit sulfur dioxide, effectively trading physical smog. The details of these contracts are mind-numbing, requiring specialized legal teams and quantitative analysts to decode. Yet, beneath the exotic terminology, the basic mechanics are straightforward. It is a high-stakes, zero-sum bet. Financial products have become to speculation what sporting events are to gambling. They facilitate the wager, but they do not create underlying economic value. By packaging these complex bets as scientific wealth management solutions, Wall Street achieved a masterful psychological inversion. They made simplicity look lazy and complexity look sophisticated. They convince the public that to build wealth, you need an elite gatekeeper who understands the occult mysteries of the market. But, as the academic evidence would soon reveal, this high-priced sophistication was actually a mirage, one designed to transfer capital from the pockets of savers to the balance sheets of institutional managers. To maintain their authority, the helpers needed to back up their complexity with the prestige of science. They turned to academia, drawing on complex quantitative models, multi-factor risk frameworks, and machine learning algorithms. Every year, prestigious journals publish hundreds of peer-reviewed papers claiming to have discovered new factors or market inefficiencies that can generate market-beating returns, or alpha. We see papers on quality minus junk, momentum strategies, and advanced machine learning for stock selection. To the layperson, this looks like objective, hard science, comparable to physics or chemistry. But look closer at the scientific foundation of these models. In recent years, the Journal of Finance was forced to implement a strict data and code sharing policy, requiring authors to submit their raw data and processing codes for independent replication. Why? Because the academic finance community has hit a massive replication crisis. Many of the highly publicized, market-beating strategies published in academic journals cannot be replicated. Researchers often engage in a practice known as data mining or data snooping, running thousands of mathematical regressions on historical stock data until, by sheer random chance, a pattern appears to work. But when this pattern is tested on fresh, real-world data, it completely falls apart. Even when the models are technically sound, they often fail because they rely on flawed assumptions. In a landmark study published in the Journal of Finance by Tim Loughran and Bill McDonald, they revealed that widely used academic research models were fundamentally misinterpreting corporate financial statements. For years, quantitative researchers used standard language dictionaries to evaluate the tone of company 10K filings, assuming that words like liability, depreciation, or share represented negative economic signals. Loughran and MacDonald proved that almost 3/4 of the words identified as negative by traditional dictionaries were actually completely neutral in a business context. The financial industry had spent decades building complex quantitative models based on literal linguistic noise. They had mistaken statistical coincidence for market reality, dressing up speculative herding behavior as mathematical truth. If complexity is the marketing department, fees are the cash register. When you sit down with a financial advisor or open a mutual fund prospectus, the fees are always presented in tiny, seemingly insignificant percentages. Our management fee is just 1.0%, they say, or this fund has an expense ratio of 1.25%. To our brains, which are poorly wired to understand compound interest, 1% sounds like nothing. It sounds like you keep 99% of your money and they take a tiny crumb off the table. Look, this is where the math of Wall Street becomes actively predatory.
Let us do some simple, cold mathematics. Suppose you invest $10,000 today, and the stock market grows at an average rate of 8% per year over the next 40 years. If you invest in a simple, low-cost index fund with an expense ratio of just 0.1%, your $10,000 compounds and grows into roughly $180,000. You paid a tiny sliver in fees, keeping virtually the entire wealth generated by the economy. Now, suppose you hire an active wealth manager who places your capital into actively managed mutual funds. Between the advisor's 1.0% fee, the mutual fund's 0.75% expense ratio, and hidden transaction costs, your total annual fee drag is 2.0%. Your net annual return drops from 8.0% to 6.0%. Over those same 40 years, your $10,000 grows to only $102,000. Think about what this means. By introducing a seemingly minor 2.0% fee, you did not lose 2.0% of your wealth. You lost 43% of your total potential nest egg. You bore 100% of the financial risk, you supplied 100% of the capital, and yet a helper who sat in a comfortable office took nearly half of your lifetime compounding returns. As John Bogle observed in Bogle on Mutual Funds, the mutual fund industry has become an aggressive marketing machine, clever to a fault, focused on increasing assets under management to maximize their advisory fees. They charge you front-end sales loads of up to 5.75% just for the privilege of handing over your money, and they charge 12b1 marketing fees to fund the very commercials they use to recruit more victims. In the financial market, you get what you don't pay for. To keep you trading, to keep you paying fees, Wall Street had to turn investing into a high-speed spectator sport. They had to create what can only be described as the financial video game. In A Random Walk Down Wall Street, Burton Malkiel describes how cable networks like CNBC and Bloomberg became cultural phenomena in the 1990s and 2000s. Across the globe, in health clubs, airports, bars, and restaurants, televisions were permanently tuned to financial news. The stock market was no longer treated as a quiet place where you buy fractional ownership of companies to hold for decades. It was treated like a major sporting event, complete with pre-game shows, real-time play-by-plays during trading hours, and post-game reviews to prepare you for the next day's match.
TV anchors and commentators, like the celebrated money honey Maria Bartiromo, regularly scheduled interviews with analysts who would confidently claim that a $50.com stock would soon hit 500. Skeptical, sober voices did not encourage high ratings, so they were rarely invited. The media demands constant drama, noise, and excitement. If a rational analyst sits on camera and says, "Buy a diversified index fund, close your computer, and go play with your children," viewers will change the channel. But if a pundit warns that the market is on the verge of careening into a horrific abyss or promises a hot stock tip that will make you rich by Friday, brother, you have high ratings.
This sensationalism creates a powerful behavioral trap. As Morgan Housel points out in The Psychology of Money, there is a deep asymmetry in how financial news is reported. A 1% rise in the market might be briefly mentioned in the evening news, but a 1% fall is reported in bold, blood-red, all-caps letters. We are biologically programmed to pay closer attention to threats than to opportunities. When we see those flashing red headlines, our amygdala fires up, triggering our fight or flight response. We panic, we ignore our long-term plans, and we trade. And who benefits from every frantic click of your mouse? The brokers and the platforms. Every time you buy or sell, they collect a transaction fee or pocket the bid-ask spread. By turning the market into a high-speed video game, they ensure that they make money whether you do or not.
But to truly understand why Wall Street's complexity scam is so dangerous, we have to look past the individual retail investor and examine the plumbing of the global financial system itself. We must look at the economics of banking and financial intermediation. In his Nobel Prize lecture, economist Douglas W. Diamond mapped out the fundamental reason why financial intermediaries like banks and securitization vehicles exist. Imagine you are a borrower who needs a massive amount of capital for a project, but individual savers only have small, fragmented amounts of money to lend. If you borrow from 10,000 different savers, how does any single saver monitor your business to make sure you are not wasting their money? It is too costly and inefficient for 10,000 people to screen and audit you. This is where the bank steps in as what Diamond calls a delegated monitor. The bank solves the conflict of interest by conducting the screening and auditing on behalf of the savers. To do this efficiently, the bank utilizes a specific contract structure known as pooling and tranching. Pooling is simply another name for extreme diversification. The bank takes a large number of imperfectly correlated loans and puts their returns into a single pool. Tranching refers to giving savers senior, low-risk claims on that pool, while the bank retains the junior, high-risk claims at the bottom to incentivize itself to monitor the borrowers diligently.
But Diamond's research also revealed a deep structural paradox built into this model, one that lies at the heart of every modern financial crisis. Savers value the senior claims issued by the bank because they are highly liquid. They can withdraw their cash at any moment. But the assets in the bank's pool, the home mortgages and business loans, are highly illiquid. They cannot be recalled instantly. This mismatch of liquidity means that the financial system is structurally vulnerable to banking runs. As modeled in the famous Diamond-Dybvig and Diamond-Rajan frameworks, if depositors suddenly lose faith in the bank and rush to withdraw their money simultaneously, the bank cannot liquidate its long-term assets fast enough to meet the demand. The bank collapses. The very mechanism designed to solve financial conflicts, pooling, tranching, and short-term debt creation, is also the primary engine of systemic instability. When Wall Street began packaging subprime mortgages into complex derivatives in the early 2000s, they claimed they had engineered away this risk through advanced mathematical models. In reality, they had simply hidden the instability behind layers of opaque complexity, setting a time bomb that nearly destroyed the global financial system in 2008.
Why do we keep falling for the complexity scam, even when the mathematical evidence is so overwhelmingly against it? The answer lies in our psychological programming. Financial success is not a hard math science, it is a behavioral soft skill. In his book, The Psychology of Money, Morgan Housel highlights how our emotional relationship with money dictates our outcomes. We are not cold, rational calculators. We are emotional, story-driven creatures. Our minds are highly vulnerable to the sunk cost fallacy and the illusion of control. We want to believe that if we work harder, study more, and pay for advanced advice, we can control the uncontrollable swings of the stock market. Wall Street exploits this desire by offering highly complex, active strategies that make you feel like you are taking decisive action. In a landmark paper published in the Journal of Financial Planning, researchers explored how our childhood experiences shape our adult relationship with money through what they call money scripts. These scripts are unconscious, deep-seated beliefs about wealth that dictate our financial habits. There are 4 primary money scripts. First, money avoidance, where individuals associate wealth with greed or corruption, often leading to financial denial and budgeting failures. Second, money worship, the belief that more money is the singular key to happiness and the solution to all life's problems. Third, money status, where self-worth is equated directly to net worth. People with this script buy high-status luxury symbols to keep up with the Joneses and appear successful, often accumulating massive consumer debt in the process. And fourth, money vigilance, the protective script. Vigilant individuals believe strongly in saving, avoiding debt, and being alert, which acts as a shield to secure their financial future.
Wall Street's marketing is specifically engineered to target our money worship and money status scripts. They flash images of yachts, skyscrapers, and high-flying portfolios to make you feel that to be successful, you must engage in expensive, exclusive financial strategies. But as Thomas Stanley's research in The Millionaire Next Door famously proved, the true wealth builders are rarely the ones flashing status singles. They are the quiet, vigilant savers who drive reliable used cars, live below their means, and reject high-status luxury items. The ultimate key to building wealth is not outsmarting the market with a complex algorithm. It is mastering your own behavior. So, how do we opt out of this multi-trillion-dollar complexity scam? How do we reclaim our financial sovereignty and protect our hard-earned savings from the helper's tax? The answer is sovereign simplicity. If you want to win the financial game, you must refuse to play Wall Street's high-cost, hyperactive game of speculation. You must step off the financial video game and build your plan on a foundation of low-cost, passive, and behavioral discipline. This playbook consists of 3 simple, unassailable pillars. First, embrace low-cost index funds. As John Bogle proved, instead of searching for the needle in the haystack, you should simply buy the entire haystack. By purchasing a broad market index fund like Vanguard's Total Stock Market Index Fund, VTSAX, you own a fractional share of thousands of productive businesses, capturing your fair share of economic growth for an annual cost of virtually zero. Second, insulate your behavior with an investment owner's contract. First designed by Benjamin Graham, this is a physical, written commitment you make to yourself. In this contract, you state clearly that you are a long-term investor and that you refuse to let a herd of screaming market pundits make your financial decisions for you. You commit to a regular monthly savings program, and you pledge never to buy because the market has gone up and never to sell because the market has gone down. You sign it, you have a trusted friend witness it, and you store it in a safe place, reading it whenever the television screams that the sky is falling. Third, establish a written distribution policy statement. For those approaching or already in retirement, Wade Pfau advocates for creating a written distribution policy statement. Just as institutional portfolios utilize investment policy statements to maintain discipline, this document outlines your targeted asset allocation, your withdrawal sequencing, and your strict spending rules in response to portfolio performance. By writing these rules down beforehand, you create an analytical defense against your own emotional volatility. You prevent yourself from making spontaneous, unwise portfolio changes during a temporary bear market.
Wall Street wants you to believe that wealth building is an elite technical battle that requires high-priced algorithms and complex strategies. They want you to believe that complexity is the signal and simplicity is just noise. But the reality is exactly the opposite. Complexity is the noise, a highly profitable screen designed to mask the extraction of your wealth. Simplicity is the signal. When you strip away the hype and the jargon, building wealth is not a test of intelligence. It is a test of temperament, time, and trust. At the end of the day, building wealth isn't about being lucky. It's about understanding how the system works and making it work for you instead of against you.